Nilesh Shah of Kotak AMC joins us. Nilesh, fantastic to have you back. We've been missing your views for a while on the channel. Why do you think Indian markets are underperforming? And do you think now there is serious merit in buying stocks? Because the scenario has become from great to poor, but the stock prices are pricing in an awful scenario. Everybody's talking about elections. Everybody's worried about debt. Everybody thinks that all Indian promoters will go belly up.
So one, Nikunj, we are underperforming the global market for last 2 months. The year-to-date performance, India is odd man out with negative performance, whereas most other countries have given positive performance. But if we look at on a 5-year basis, India is a standout performer. I did some analysis where Indian markets were outperforming Chinese market by almost 50% in US dollar terms over 5-year period towards end of 2018. With some performance in China, 50 would have become 40. But if you are outperforming Chinese market by 10% in US dollar terms for every year, I think that's a significant outperformance. If you outperform so much, then there is a reasonably good chance that at some point of time other people will play catch up. Chinese economy is 4.5 times bigger than us. Their market cap is barely 2.5 times bigger than us. So obviously people would like to take their profit out of India and allocate into other emerging markets. That's one side of explanation. The other side of explanation, as you mentioned correctly, is relation to election uncertainty. As there are elections approaching over next 3 months, people want to be cautious. They want to be keeping their money on sidelines, and they'll take investment view probably as market starts pricing in election results or post-election. The third thing which is also happening in the market is that the flows have become shallow. Domestic mutual funds have witnessed slowdown in flows. FII flows are marginally positive, but combination of that, the institutional flows have turned a little bit shallow, and all these things put together is creating its impact on the market.
Right. So Nilesh, as an investor, what is it that you do? Do you keep, if you are sitting on some amount of cash and you've kept the powder dry for some clarity on elections, do you jump into your investments only post-elections? Or do you think right now is the time, these 3 months that you do your grind work, mid and small caps have already fallen, you start nibbling in right away?
So we don't take cash call. My job is to outperform benchmark index. Our fund mandate is not to generate absolute return. Taking cash call is double-edged sword. It can work very well in a falling market. It can hurt quite badly in a rising market. So we don't take cash call. We remain fully invested at all possible times. Now we know there is an event risk coming ahead, and that's the election. The history tells us that elections matter on the result day. But over a period of time, over the tenure of the new government, it's the work done by the government which matters. So while we do keep a watch on election, our better analysis will be focused towards what work has been done by the government in last 5 years and what will be done in the next 5 years. If you look at market, they have started pricing in electoral risk. Many small and mid-cap companies are available at a significant discount to their historical averages. Even in large cap, there is wide polarization. 9-10 companies are trading above their historical average. Many companies are trading below or around their historical average. So as a fund manager, our job is to keep on meeting management, trying to understand how their businesses are running, and try to find out what is available at a reasonable valuation in this market.
Sure. But Nilesh, if fresh money is to be deployed, where does that money find its way then?
Essentially, as of today, if we see, there are a couple of trends which we are playing on. One more talked about trend is the financialization of saving. Yes, there is little bit of slowdown today in mutual fund flows, but if I look at over a period of time, flows have been fantastic. There is increasing financial savings which will benefit banks, NBFCs, mutual funds, insurance companies, microfinance institutions. Now within this, we have to pick up right banks because There are some retail focused banks which are trading at one valuation. There are corporate focused banks which are coming out of NPA cycle. There are some NBFCs which are facing tremendous issues related to their growth expectations. There are some NBFCs whose liability franchise is enabling them to continue their growth path. So you have to then create a bottom-up portfolio out of this broad trend of financialization of saving. The second trend which we are trying to capture is eminent improvement in investment. Over last couple of years, tight liquidity, high real interest rates, lower capacity utilization all came together, and also the debt-ridden balance sheet which came together to kind of subdue private investment. Now the capacity utilizations have started hovering around 75-76%. Interest rates are on the way down. Liquidity hopefully will improve, and many companies have repaired their balance sheet. They will be looking for future from an investment point of view. Combination of this creates a revival of capital goods sector, and more importantly, in this capital goods sectors, number of companies which are participating has come down vis-a-vis 2008. Now companies will be able to demand their margin because their capacities will be limited, and combination of this can create better days for capital goods sectors. Again, on a bottom-up basis, you have to pick up which sectors will do well. For example, in power, there is little hope right now of new investment, but in sectors like refining, petrochemical, steel, cement, there could be better expansion. So again, on a bottom-up basis, you have to pick up the portfolios. The third trend, which is a little longer term trend and which we believe will continue, is the construction in India. There is huge demand for construction activity led by government spending as well as private spending. And clearly, we believe with RERA's introduction, real estate sector will start bottoming out. It will invite, or it will attract serious players. It will attract foreign capital, and we will see a reasonable amount of longer term bullishness in Construct in India trend. Now, the way to play this again is not via real estate sector per se because of governance issue, but maybe it's worth playing via cement, via building materials and other ancillary sectors. So these are some of the trends which we are trying to capture over a longer period of time, but more importantly, it is the bottom-up analysis which is telling you which stock to invest into.
Let's get in your view then on N. Chandra's plan. You know, he's been at the helm for the last 2 years, and the kind of interventions that he has made with Indian Hotels, Tata Steel, that really seems to have paid off. Now he's training his guns on Tata Motors in particular, talking about a complete revamp in the overall business and basically to prioritize the loss-making JLR unit. What is it that you've made of the progress that we've seen for N. Chandra so far, the Tata group of companies, the story that's really played out in Tata Motors? What is it that you would like to see here?
I would like to refrain from stock-specific comment, but while Tata Group provides a particular branding for the group, for us every investment is an individual company. If TCS does well, there is no guarantee that Tata Motors also will do well. So while we do respect the Tata brand, we evaluate all this company on an individual basis.
I'm just going to, for the benefit of our viewers, look at three charts here. The 3 and the 5 year chart for the Nifty, the 3 and the 5 year chart for the small cap index, and the 3 and the 5 year chart for the mid cap index. I'm not looking at 1 year because 1 year will not give anybody a true picture, because we've seen a sell off in mid and small cap stocks. In last 3 years, the Nifty has given you a 50% return. In last 1 year, this is again 4 years, 3 years. In last 3 years, the mid cap index has given you a 38% return, and in last 3 years, the small cap index has given you 28% return. So Nilesh, small and mid cap stocks are now underperforming the Nifty. The argument against small and mid cap stocks a year ago was that small and mid cap stocks were trading at valuations which were, or small and mid cap indices were trading at valuations which were richer than the Nifty, and they were outperforming the Nifty. So now, is there a case for anyone to, let's say, start a mid cap SIP? Whether it's a Kotak mutual fund or some other mutual fund, that's a debate. But in general, as in portfolio allocation, is there merit in buying a SIP of, SIP of a decent quantum in some of these schemes?
Undoubtedly, we think right now small caps and mid caps are attractively priced vis-a-vis their historical average. They are trading at a marginal discount to historical average. Large caps are trading at marginal premium to their historical average. More importantly, if the economy starts growing at a faster pace, courtesy an overvalued rupee correcting, so there will be limited Chinese dumping, higher liquidity as we have contained the menace of inflation, and lower real interest rates as again we have controlled the menace of inflation, then the small and mid-cap companies should benefit from the revival at a much faster pace compared to large caps. Many large cap companies are exposed to global cycle, and there is fear in the global market that growth in 2019 calendar year and in 2020 calendar year could be subdued. There are many economists who are talking about recession in US somewhere towards 2019 and 2020 beginning. We really don't know what will happen over there, but if global growth is slowing down, that's going to have more impact on large caps compared to mid and small caps. If Indian growth is reviving, it's going to be more beneficial to small and mid cap compared to large cap on a portfolio basis. And hence, keeping in mind the growth potential and the valuation differential, one can start allocating towards small and mid cap. The only caveat is that there is an event risk of election, and in case market gets a shock in terms of a government, then the small and mid caps will be impacted far more compared to large cap.
So looking at where we stand, Nilesh, in terms of the earning cycle, some would argue that every year we start with the assumption that this year will be better. Ye saal earning ke liye acha hoga. By the time we wrap the year, we say, chalo, this year was bad, next year will be better. I get a sense that we could be doing the same thing this year also. 2019, we started the year with thumping our tables, good year, corporate banks will make a comeback, cyclicals will look better. But 2 months into this year, and suddenly everybody is looking at each other's shoulder, trying to find an island of growth.
Nikunj, your point is absolutely valid. Over last 10 years between 2008 to 2018, Nifty earnings growth has been just about 5%. So there's no debate about what you stated. Let me give the counter picture. In 2003, corporate profit as a percentage of GDP was roughly about 3.5%. It went up to 5.5% as we went on a credit spree. Money was available easily, foreign investment was coming in, we pursued the path of fiscal prudence from 2004 to 2008, and all that combination resulted into profit growth speeding up quite dramatically. It reached at a peak of 5.5% of GDP. Today, your corporate profit is back to 3.5% of GDP. So somewhere we have completed a full cycle. There has been sharp drop in profit as a percentage of GDP, and which is why Nifty earnings have compounded at 5% between 2008 to 2018. Now, where has this drop come from? If we look at EBITDA margin for corporate India at 18.9% for FY18, it is above average. But the PAT margin is below average. Now, between EBITDA and PAT, there are three things: depreciation, interest, and tax. Tax rates have come down, so tax could not have impacted this drop. Depreciation is unlikely to gone up substantially because very few investments have happened in last few years. Effectively, it is the burden of interest which has pushed corporate profitability down, and that is reflected into high real interest rates. We sustain that high real interest rates and tight liquidity to bring down inflation from double digit to single digit. Now that inflation is well below RBI's comfort zone, it is quite likely that we will see real interest rates getting realigned and liquidity improving. If that happens, the corporate profitability will start improving. Somewhere, not exactly, but in certain fashion, we are where we were in 2004. Rates are coming down, liquidity is going up, rupee is stable. If government pursues the path of fiscal prudence, which this budget has indicated, then there is a reasonably good chance for this corporate profitability to jump from 3.5% of GDP. It may not go to 5.5%, but certainly it can go towards 4.5%. The third argument, again on a bottom-up basis, the three corporate-focused banks, 2 private and 1 public, will swing into profitability on a massive basis in 2020 compared to consolidated losses in 2018. We also see some of the pharma companies delivering better results in 2019 as well as in 2020 over 2018. Then there is a brutal war going on in telecom sector, which has depressed profitability of all the telecom players. Our expectation is that at some point of time in future that pricing will end. There will be some uptick in pricing, and that will result into swing in profitability. And you yourself talked about 2 global conglomerates from Tata Group which are trying to improve their performance and contain their losses. So on a bottom-up basis, there is hope from corporate-focused banks, from telecom sector, from pharma sector, and from global conglomerates that profitability in 2020 could swing significantly over 2019 as well as 2018.
I hope it happens. I really hope it happens. I mean, auto also has seen a slowdown, so last quarter got impacted because of Maruti numbers and all, and I hope they really stabilize. So fingers crossed, Nilesh. Great to have you back. Always love hearing your views, and thank you for your time, and thank you for sharing your thoughts.